Measuring carbon is a quantifiable measure. Adaptation is harder to measure. We can see the flooding. We can see the impact on food and water scarcity. How do we bring solutions that help us adapt to this reality? Southeast Asia as a region is one of the most vulnerable regions in the world. The thing that really blows my mind is...
Alina, thanks so much for doing this with me today.
I'm excited. Thank you.
I want to start with something that I think shaped everything about who you are today. You were born in Riga, Latvia during the Soviet era. When you were about 10 years old, the Soviet Union collapsed and your world completely fractured. Your family faced discrimination and death threats because of your ethnicity. And that led your family fleeing to Australia as refugees. Now, when I think about a 10-year-old child experiencing that level of trauma and displacement, I wonder how that child makes sense of her world. And what story did you tell yourself about why this was happening to you? And how did that story evolve as you grew older and gain some perspective on the whole situation?
I think that the last point is incredibly important, right? Perspective. As a child, and my theory is that all children, you make your world into a very beautiful place. And despite kind of the challenges, and as you say, children go through all sorts of complex situations, much more complex than what I have gone through. We'll have different experiences, but somehow childhood is sacred. As children, we're born into being so adaptive and so resilient and creative and really open to the world. And to be quite frank, like not knowing any better as a child growing up. And so I had a wonderful childhood. I have the most fondest memories of my family and of being in nature, which of course we'll get onto the kind of the conversation later on about how that has changed in our world, the ability to go out and see the flora and the fauna, its natural environment, with climate change that has been impacted. In many ways, I didn't realize or recognize or appreciated the impact or the influence that time has had on me and on many others, right? And certainly on my parents. And it has taught me a lot and has absolutely made me into the person I am today.
Were you aware turmoil brewing in the background, or were you oblivious to it?
I wouldn't say oblivious to it. I think I'm very fortunate to have two incredible parents who always treated me like an adult and have always shared things and were always transparent and would always kind of explain things. So 10 years old is when we actually left Latvia and moved to Australia, as you've described. Things started to shift specifically in Latvia around sort of 1991. You are seeing impacts across all levels of society. The economy has collapsed, all sorts of turmoil and chaos. I was a child going to school. I do have memories of going to a birthday party and being told by my best friend that her father was just killed and it's her birthday. And as a child, you're processing this. You don't understand why, you're trying to connect, but you're still a child. My parents took me out of school. So actually for the last sort of year before we left to Australia, I was homeschooled, myself and my sister, who was 3-4 years old at the time. But it's only after the fact that you realize the impact that brought about in your life.
For 5 years, when you got to Australia, you lived as stateless refugees. I think you were in Red Cross housing, going through tribunal hearings. And as a child, you were literally scenario planning your own deportation. You had absolutely no control over your future. People who've experienced profound uncertainty like that often describe it as either breaking them or forging something profound inside of them. What was it for you? And what part of you today is still that child who learned to live with, I guess, no guarantees of what's to come?
It really taught me to be incredibly adaptive. Since then, I have been fortunate enough and privileged to live in incredible parts of the world and work in incredible parts of the world, from Africa to Asia to now the Middle East, Europe, of course, as well. And everywhere I go, I feel like it's home in a way. And it's wonderful to connect with people and it's wonderful to navigate the differences of each country. So it definitely taught me adaptability and, of course, resilience.
Your parents were qualified doctors in Latvia, but when they arrived in Australia, their credentials weren't valid. So they just had to take unskilled labor jobs to survive. Ego is often the thing that stops people from doing what needs to be done. What did you observe in your parents during that time that taught you how to separate your identity from your circumstances? And have you ever had to draw on that lesson yourself when rebuilding something in your own life?
Observing my own parents and observing other parents. I think that as a parent, you do so much for your kids, and they have always put us first and have always wanted to create the best enabling environment. I've seen two incredible professionals, experts in their field who had their own business, their own practice, had to go back to ground zero. That takes a lot of courage and that takes a lot of hope. Not knowing whether they would ever practice again, just giving all of their careers up for the children and for the betterment of the family. Strength also has something to do with it. Entrepreneurialism, right? As an entrepreneur, you often go through cycles of hardship and challenges. And even though I'm now sitting on the investment side, I too am an entrepreneur. Every investor is an entrepreneur. And so being able to, again, navigate these cycles of incredible complexity, incredible challenge, and picking yourself up again, and with incredible determination, and starting again or restarting or building fresh or building new is no doubt something that I've benefited from by watching my mom and dad go through that period.
You desperately wanted to follow them into medicine. You applied to medical school twice, rejected both times. That had to hurt. But looking back now, how do you think about that rejection? Because it definitely forced you into a completely different trajectory. Do you view it as a gift? Or does that part of you still wonder what would have happened with your life if you had gotten in?
I think a lot of the desire to become a doctor actually stemmed from the cultural context in which a lot of I speak for Eastern European societies, embedded this notion that you have to be somebody of substance. So you're either a lawyer, an engineer, a doctor. And so a big part of that, I think, was embedded in my psyche. If I'm to succeed, I need to be somebody in one of those professions. Was I fascinated by necessarily the medical aspects? Maybe. I remember sort of some of my favorite books. I was fascinated with a lot of the historical medical innovations. I would seek out museums that presented these kind of artifacts and assets, and I absolutely love it till this day. I was a really excellent student. I skipped grades. I received a lot of accolades and certificates for really excelling in mathematics and biology and physics and you name it, in chemistry. The twice that I've sort of applied, it hurt a lot. And it was the first kind of proper failure in my life that I kind of experienced and taught me a lot. But in hindsight, even wonder if I did get into medical school, whether I would have finished it, because I very much love and am driven by many other things that would not have been possible if I became a doctor.
Well, you ended up studying media and communications at the University of Melbourne instead. And then after graduation, you started your career in corporate media with stints working for WPP group agencies, Mindshare and MediaCom, and you were managing portfolios for multinationals like BP, Ford, Kodak, Foster's Group. Tell me about that time and your takeaways from that experience.
It was one of the most fun phases of my life. I absolutely loved working within the creative environment. I was very much on the media business side. There's the creative side and then there's the business side. You have a marketing budget. You need both sides to work together to allocate strategically to kind of drive to the goals that you're trying to drive. And you need the creative side to obviously deliver the creative. So I was on the business side, but still the whole dynamics of the media industry at the time, and this was pre-online world. So the internet was definitely there, but we didn't use online media to reach our audience and to market and to advertise in the way that it is done today. Facebook just came out, but pre-TikTok, pre-Instagram and all of that. So we worked a lot with TV, billboards, radio ads, magazine ads, and it was just wonderful. And again, it was the people, it was the nature of the problems that we're trying to solve. And I learned a lot about behavior of consumers or any sort of specific target audience. And understanding human behavior is an incredibly important aspect of being a really good investor. Some of the early sort of, again, skills that I've developed whilst in media has really served me very well in my next third chapter of my career.
So not terribly long after that, you made a decision to leave corporate media and go back to school. You went to the Geneva Graduate Institute for a master's in international affairs. Now that's a pretty dramatic pivot from corporate media to international affairs. And geographically, you left Melbourne and came here, in fact, in Geneva, Switzerland. And when I look at that decision, it seems like you were searching for something different or deeper than career advancements. What were you running towards, or maybe more importantly, what were you running away from?
The realization was that I really wanted to do something at scale. And Australia is a big country, but not as big as trying to have an impact across the world. And it was a combination of realizing that actually working within a corporate has incredible discipline, but it also brings a level of bureaucracy and hierarchical sort of career channels, which in and of itself is fantastic, but not something that perhaps I was interested in. So I was looking for a career that allows me to have deeper impact and at scale. Actually, before coming to Geneva, I studied 1 year in Paris, in France, at Sciences Po as well. That was the real first moment when I was embedded in the world of international affairs and international development. Sciences Po is a very well-known university for that. I just got really excited about the potential and the opportunity that comes from the multilateral ecosystem of the World Bank and the United Nations and many other organizations, and absolutely fascinated. The story goes that actually coming back from Sciences Po, which was, as I said, sort of just a 12-year sort of exchange, I knew that I wanted to pivot out of corporate and go into a development context. And I've only applied to the one master's, which was Geneva. But it was that pull towards global learning and global cultures, but also moving away from just corporate into the impact in the development world and international affairs world as well.
So then you got out, and then 2011 timeframe, you joined the World Bank Group, and specifically for the Global Facility for Disaster Reduction and Recovery. And I guess you spent in total 6 or 7 years there working on disaster recovery frameworks, private sector partnerships, and climate resilience at a global scale. Walk me through what you did there, and what did you learn there about how large institutions actually operate?
3 key figures influenced my time there. I was lucky enough to work under 2 different presidents. The first president had a very much kind of a trade policy background. He was previously a USTR, US trade representative, and brought a very traditional World Bank macroeconomic policy and a very kind of geopolitical lens to how he ran the organization. The next president had a very different background. He was a physician and an anthropologist by background. And he's actually developed and restructured the entire organization based on this new mandate to say we actually need to look at poverty reduction a lot more. We need to catalyze private sector capital. He's kind of coined the term of sort of turning billions into trillions, driving a lot of the development work together with private sector as well. And he came from a health background, so there's a lot of understanding of the complexities around the different industries. My direct supervisor manager was the special representative to the UN and WTO, who also had a private sector background. All these things kind of really influence and shift not only how obviously the organization works and the mandate, but also how you actually influence some of these policies, how you actually drive towards some of the goals and outcomes that we're trying to achieve as an organization. But we also looked a lot and worked very closely with the World Trade Organization for the trade agenda, but also with World Health Organization on the health agenda, ILO on kind of jobs and workforce and employment and labor. So again, Geneva is this melting pot of innovation and international collaboration and work across these different sectors. And, we were at the epicenter of that. I spent quite a significant time there and worked with incredible people across different countries, of course, with HQ as well in Washington. But eventually I realized that large organizations, very similar to the kind of private sector and the corporate world I was in before, they are large by nature. And my desire has shifted towards wanting to drive innovation at scale, but with a lot more speed, autonomy, independence, creativity. And I found myself actually interacting with a lot of entrepreneurs, advising some of them or partaking in some of the kind of conferences and even actually joining demo days and hackathons and starting a few concepts by ourselves. And that really opened that world to entrepreneurship and innovation and investing as well. And so that was the door open to that led me to my next chapter.
You were working on disaster recovery frameworks and private sector partnerships, but day in, day out, what was your job? I've been living in Geneva for, 35 years or something like that. And it's kind of a parallel universe, people who are living and dying by results. And then there's this monolithic buildings, and it seems like one conference after another. What were you doing?
I was part of the organizational pillar called External Corporate Relations, meaning the liaison office with the other kind of organizations that we find in Switzerland. And we were not mandated, for example, to be on the ground, unlike the country offices of the organization where you've got the country manager and the people who are working in country directly with the governments and in some cases private sector and different stakeholders. So we were very much on the liaison side to collaborate, to advise, to participate in these dialogues, in formulating these international agreements where all these organizations are coming as parties. A big part of it was my desire to actually have more of an impact or more of a role to play with people on the ground. But I did know that I didn't want to necessarily just be working on policy side or external relations side. I want something that is much more dynamic, where you can build new systems or new vehicles and shape the way ecosystems and markets work, but not just through policy, but in other means as well, through funding and through actual innovation.
I imagine you went there with a lot of youthful ambition, thinking you're going to change the world. Was there a moment where there was a realization that made you understand that this wasn't the vehicle for the impact you wanted to create?
It wasn't just a singular moment. As I started to engage with startups, with entrepreneurs, I found myself much more pulled towards that direction and realizing that actually that is where you can have an incredible impact and results and outcomes. And you can bring both the private and the public sector together, and you can innovate and you can build. It wasn't a singular moment per se. It was a very sort of gradual but short-lived realization that there's another opportunity out there to bring in some of the investment and the private sector to a world that is predominantly working with governments and within the development scope of the multilateral system.
Then around 2016, you joined an organization called Spring Accelerator as a corporate partnerships manager. It was some kind of a fund. Tell me what the mandate was and what were you doing there?
Spring was a gender-focused impact accelerator. It had the backing of governments, but also foundations. So specifically, we had the UK government, DFID, the Australian government, and the US government as well, USAID, as well as a Nike Foundation. And they came together and they partnered with a design agency, which was really novel at the time. Usually design agencies work with private clients, called Fuse Project. It was a consortium whereby we developed a very unique and novel, at the time, obviously now things have changed, approach to building businesses, which was through human-centered design. We've worked across South Asia as well as East Africa with entrepreneurs on the ground, with teams on the ground, with really early stage companies and founders. And we looked at influencing or embedding, impacting adolescent girls throughout the value chains of those businesses. We developed this incredible curriculum that helped businesses not only build the business themselves, because that had to be a sustainable company, but also think about the gender lens investment aspect of it. We had 76 companies. We have reached over 2.5 million adolescent girls in that time frame, which was an incredible result.
This is mostly emerging markets, right?
This is all South Asia and East Africa. So all emerging
So this was kind of your boot camp in the emerging market venture building. Was there some kind of reality check for you when you moved from World Bank policy meetings in Geneva and Washington, going to the ground floor of a startup ecosystem in Nairobi or Delhi?
So many moments, so many learnings. We've traveled to places like Pakistan, spending time and having dinner with families there, being in the middle of Nairobi or in the middle of Lagos. You learn a lot about humility and you learn a lot about what it takes to build and how important it is to understand the realities of that market and of that culture and of the history of the people. Till this day, we always say everywhere we go, we're a humble guest in that country, which is absolutely true. And so having that, again, human-centered notion of you don't know better. you never will because you didn't grow up in this country. You don't know the problems of the country, but you can bring some technical expertise and you bring capital and you bring knowledge and know-how around how to build, and magic can happen. If you come with that mindset, it's amazing what you can do. And we have been doing for the last 10 years.
After you moved into this VC world, you did go back and visit some of your former World Bank colleagues, and someone told you that you had joined the dark side. That comment is very revealing to me about the psychology of the development sector. What did that moment teach you?
I'd like to think that that comment wouldn't be made now, but I think it is being made in certain circles and forums and dialogues, unfortunately. I think we're still living through this paradigm of not understanding, or not appreciating rather, the opportunity of blending incredible commercial outcomes, sustainable financial outcomes with the depth and the breadth of impact. I mentioned one of the World Bank presidents coming in and talking about how do you leverage, bring in, and catalyze more private sector funding. I don't know, because I'm obviously no longer part of that development ecosystem, but I bet my bottom dollar those conversations are still happening. How do you bring the public and the private? And I think it all comes down to so many things. It is the mindset, it is the incentives, it is the talent, so many things that are so diverse that we're still, as a collective, as an international community, not appreciating and really understanding the opportunities and bring us towards. We've moved a lot, don't get me wrong, and I think we've done so much. But yeah, I think there's still room for growth there.
I want to continue to explore your journey through the dark side here. After about a year and a half, you moved to A2B as Director of Partnerships and Growth. And I guess this was an innovation lab, also focused on emerging markets. What were you doing there, and what was the gap or the opportunity you saw in the market that A2B was trying to fill?
One of the things that happened at Spring that has had a strong, obviously, influence on my career and what I've done since Spring is that I met my business partner, and we have been building and continue to build across emerging markets.
You're referring to Rue Rogers, is that right?
Correct. Yes. Okay. We've been building across different markets, different regions, or different levels of maturity of ecosystems. But we've always been building with early stage founders and startups. So ATB was a transitional company that we set up whilst we're also figuring out actually what are the different vehicles.
Oh, you and he set up A2B?
Correct.
You met him on a mountaintop in Nepal.
My recollection, I think it's certainly his, is that we met on top of a mountain in Nepal, which is one of the places where Spring was very much present. Again, very much human-centric approach towards building. We had all the founders come in person and spend 2 weeks together. What I always add is that it wasn't just a meeting, it was a very heated debate and argument. I can't remember what we were arguing about, to be honest, but I do remember that we were arguing, which is really very much the nature of our partnership ever since, in that he and I are very different. We bring different experiences, different points of view. We always try and see a situation or an opportunity from different lenses. So that mountaintop debate became an icon for what's to come.
Were you with a group of people, or were you up there and you literally ran into them, or what?
We were with a group of people, but the real sort of moment of sharing what I think and what he thinks. Again, I can't remember the subject of conversation, but I remember feeling very passionate about it.
After that experience, or sometime after you came down from the mountain, you guys decided to build this thing called Founders Factory Africa. Talk me through the genesis of that. How did you decide that Africa needed a fundamentally different model than the traditional 220 VC fund, and what was broken in the existing model that you felt that needed to be fixed?
We didn't decide to build Founders Factory Africa sort of right off the bat. We really realized that we wanted to continue to build businesses. Spring was such an incredible learning experience for us. We've built such great relationships and networks with people, with some of whom we still are in collaboration today. But we wanted to build something sustainable. One of the lessons, and there was many, but one of them was we wanted to create a vehicle that is not just providing grants. We wanted a financially and commercially sustainable vehicle. Now, naturally, funds, as a traditional VC fund goes, are the natural thing to look for. But you must remember that at the time we're working in emerging markets, right? Where funds were almost non-existent. When we started FFA, there was something like 600 million in VC funding total across all of the continent. In Africa, that's not even looking at other emerging markets. But the other lesson that we learned was that emerging markets and early stage founders need more than just a check. They need more than just funding. We work with entrepreneurs that have incredible IP, that are incredible founders and leaders, but we work in environments where there isn't the same infrastructure or the same resources, the same ecosystem. When we started the Radical Fund, which is a climate tech fund in Southeast Asia, till this day, there aren't the right resources for climate tech startups. And that is a very mature ecosystem with many funds being established for many years, right? The realization is that we wanted to create a vehicle that was appropriate for the needs of the companies and meeting the needs of the specific market where we're in. That is what we did. FFA was kind of a corporate-backed accelerator and incubator, but we did put in commercial capital, but we didn't structure it as a fund. So it was an operating company, meaning we invested off our balance sheet. Our investors were shareholders in the company. That's how we invested in pre-seed to Series A companies across different sectors, but predominantly health, agriculture, and of course, financial services or fintech.
Who were your investors in the company?
We had Standard Bank Group, we had Netcare Group, and then we had the Small Foundation.
What was the core insight you were selling to investors to get them to go into this new company? Because it was a different concept, right?
Our model and our belief is that you need to structure and design vehicles that will deliver commercial returns, but that will also drive innovation. So we positioned it very directly, which is that 2 in 20 models as VC are not enough from a commercial point of view to actually build a team that is able to de-risk your portfolio. We've invested in 56 companies under the FFA umbrella, and early stage needed a lot of that technical expertise, a lot of the product and tech support, a lot of the go-to-market and growth support. And the 2% management fee just doesn't allow one to do that if you're starting a fund where you can probably have 3, maximum 5 people working at the fund. So in order to build and grow companies in such nascent startup ecosystems, in order to support companies through more than just funding and capital as it goes, you needed a team, and you needed a lot of corporate influence, corporate assets, and corporate value add as well. So the other part of it is that these backers of ours actually contributed a lot of know-how and data and insights around customer problems where we could actually build around. That was a very compelling and differentiated model.
If it wasn't 2 in 20, how did it work?
So it was structured as an operating company, and our investors are shareholders, and we were investing off our balance sheet.
Fast forward, you stayed at Founders Factory Africa for about 5 years. You were chief strategy officer and was quite successful. You raised over $140 million in capital from corporate investors. And I think you built a portfolio of somewhere around 55 or 60 startups. Somehow all good things come to an end. And in 2023, you left your executive role in something that you built and was working to start something new. What was the internal restlessness or the calling that made you realize you had to move on?
I remember the time very vividly. It's always hard to move on. Actually, we've built so much value, and I don't mean just financial value. I mean value in terms of social value and network and IP and education. I really wanted to take that to the next level. Many, many lessons stemming from Africa, one of which is that we were working with incredible founders across these sectors that really had a indirect, or in some cases very direct, connection with climate. I realized actually that what I wanted to do is to also explore a different region, a different context, a different startup ecosystem, a more mature one, right? Southeast Asia is 5 years ahead of the African ecosystem, purely in sort of VC terms or maturity terms. I wanted to start a fund, and I wanted to start something that actually drives meaningful climate impact, but it's still retaining as funds go, it's commercial nature. Starting Radical, and we called it the Radical Fund because we need a really radical shift in thinking and mindset and understanding what climate is and means, and a radical shift in behavior as well. That kind of thinking around being more disruptive as consumers, as businesses, as different stakeholders. That's how the Radical Fund was born. And we started, our first close was July 2023, but of course we started before that. I moved to Bangkok, a fascinating place, and we started Radical.
Help me understand the chronology here. You said you started Radical Fund first, but you now have something called Utopia Capital Management, which is a platform, not a single fund. Can you paint me the 10,000 meter picture of what Utopia is and where Radical fits in? Then I want to drill down on Radical a little more.
Utopia Capital is, let's call it the topco, the holdco, the top line company. It is a platform of investment and innovation vehicles. Specifically, it's VC funds and now a studio that combines capital or funding, local and regional talent and expertise, and tech, including AI infrastructure. And it operates, or it manages, or as part of the platform, we have the Radical Fund, and most recently this year as well, our Middle East Fund, which is called Atypical Ventures. And we have the Utopia Studio as well, which we also announced this year, which is an AI native studio that is both building companies in AI native sectors, and it also works closely with existing early stage companies to basically speed up their growth, but also facilitate their expansion and, again, their technology infrastructure as well. So Utopia is both an entity, but also a platform.
When was Utopia formed? Was that at the same time as Radical, or is that post, once you started developing more organizations?
It was about the same time, correct? Yeah. Yes, it was about the same time.
And just so we know where we're going, you're finance first, but all of these are looking for impact at scale.
I always say that we are commercially first with impact embedded. You may have used the phrase, and this phrase gets used a lot, which is profit with purpose. As a VC, as a fund, by nature, you are looking for commercial returns for your LPs, all stakeholders, to return the fund above or market rates, right? We're not concessionary, we're not patient. In many ways, catalytic, yes, but we're definitely looking for a 3x return with above 25% IRR, with above 1.5 DPI, et cetera, et cetera. But impact is very much embedded in how we run our organization, how we work with our founders, and the performance that we're expecting from our entrepreneurs as well as the fund as well.
And commercial means market rate or superior, and you're
Correct.
Nothing about concessionary, right? But at the same time, it needs to have impact.
Impact can be defined in so many ways. Even with the Radical Fund, we have an incredible team who's worked on identifying across climate mitigation and climate adaptation, which is the spectrum that we work in, trying to measure and very clearly articulate what impact could be for each and every startup that we invest in. There's a lot of complexity within that, right? Maybe at a high level, in summary, we think of impact across sort of 3 layers. We think of it, of course, at a venture level. So working closely with entrepreneurs around identifying what that impact is. As climate fund, specifically for Radical, that is very important to us, right, in Southeast Asia. We then look at it as a portfolio level. So as portfolio aggregated your results, whether it's greenhouse gas emissions or whether it's the impact on livelihoods or losses averted, right, from an adaptation standpoint, like aggregate portfolio level. And then there's the fund level. The Radical Fund does a lot of that as a climate fund. Our Middle East fund is slightly different in that our biggest impact there is very much either ESG focused. So again, looking at potential risks, right? And looking at impact at an ecosystem level. Our Middle East fund isn't measuring necessarily GHG emissions because it's broader in nature and its investment thesis has different sectors, which we can talk about. So it very much depends on the market, the region, the type of company, and looking at what that impact implies in that case.
I'm always interested in the name. Utopia, how did that come about?
There's always two stories to a name. The personal stories, my business partner said that I say that word a lot to mean a certain sense of idealism, something that means too good to be true. This would just be utopia. Like if we get this 3x return on this business, that would be utopia, right? So I use it as a figure of speech. But the other related to why we chose that name it comes back to our previous conversation about what is possible in emerging markets and VC and investing and early stage investing is really misunderstood. Until this day, I spend a lot of my time educating, enlightening people who have certain misperceptions about what it takes to work in the Middle East or work in Indonesia or work in places that to them seem very far and challenging and complex. Last week, I came from Lebanon, from Beirut, and it was, again, very interesting, the conversations that I've had with people who either didn't want me to go or were really incredibly surprised that I went. And yet it was one of the best trips in a city that's incredibly secure, at this moment, and people who want nothing but to enable and to support and to work closely. So that misperception still persists. So Utopia in the end is trying to break those barriers of what it takes to build innovation, what it takes to invest in these regions that are misunderstood, what opportunity means and how, the talent, the people, because in the end, it's all about the people. And we think utopia is possible.
Well, then let's talk about that. Let's start with Radical Fund. You've already mentioned it. It's your Southeast Asia climate vehicle. Launched it with a target of 40 million. I guess that's dollars. And walk me through the mission and the theory of change of the Radical Fund. And what's the specific problem you're trying to solve with this vehicle that no one else is addressing?
When we first had this kind of concept of what would it take to launch a fund in Southeast Asia with a climate sort of focus, we very quickly realized actually there are not many climate funds in Southeast Asia. And of those that existed, majority, if not all of them, focused on climate mitigation. And it's very unfortunate also that a lot of them invested outside of the region. That to me was both shocking, but also an impetus to create something that is integrated, something that creates value and, of course, wealth and performance in the region rather than investing in the US or Europe where investments are seemingly de-risked, and to build a fund that it's obviously long-lasting and provides both, again, that climate impact and, financial returns. Our sort of USP, if you like, or our differentiator is that we cover both mitigation and adaptation. We look at it holistically. Of course, we invest in early stage. So for us, that's pre-seed to Series A and, very much focused on Southeast Asia. So we do not invest outside of the region, meaning founders need to be either operational in the region or have significant customer base in Southeast Asia.
And target returns are typical VC returns, right?
Correct.
Yeah. Is this a closed-ended fund?
Correct. Yes. Yeah. In that way, it's a traditional VC fund.
You've talked about the missing middle of Southeast Asia. You've said that 90% of global climate capital currently flows to mitigation that reduce emissions, things like solar farms and carbon capture, but almost nothing goes to climate adaptation, which is more about helping the communities survive climate impacts that are already here and happening. So why is adaptation the more urgent investment thesis for Southeast Asia? And what makes it fundamentally different from mitigation as an investment category?
It's quite obvious now that Southeast Asia as a region is one of the most vulnerable regions in the world due to climate change. And at the same time, it's also one of the largest emitters of the world, right? The thing that really blows my mind is when I talk to people or talk to climate skeptics, let's put it that way, it is visible in that we can see the rising sea levels, right? We can see the flooding. We can feel the stress that comes from heat waves. We can see the impact on food and water scarcity. We as people are very much in it. And I have this kind of stories that when I first landed in Bangkok, I remember people wearing masks outside. And this was just after the COVID era. Why are people wearing masks outside? Don't they know actually COVID is going down? And by the way, if you're outside, you don't need to wear a mask.
Yeah.
Only to then realize, as my lungs filled up with polluted air, that they were wearing it because of pollution. And I myself actually suffered. I literally couldn't breathe. I had to buy an oxygen mask. The pollution is so bad in some of these places. And it's not the only place, right? It is here. It's not going to happen in 10 years' time or 20 years' time. We are already being impacted. So how do we bring solutions that help us adapt to this reality? Now, why is it hard? Again, many, many reasons. I always say actually mitigation is much, much easier to quantify. So whether you're an investor or your development finance institution or your government, measuring carbon is a quantifiable measure. And you can price it, you can model it, or you can put it into a spreadsheet and you can look at it. Adaptation is harder to measure, and identifying kind of what KPIs are around resilience or around risk reduction or around avoiding losses. There's a lot of probability. There's a lot of hypothetical. There's a lot of assumptions. And there's a lot of non-linear, non-quantifiable sort of KPIs and metrics. So it's harder to measure and to manage. Another reason is traditionally, most of the adaptation dollars came from large infrastructure real estate and therefore large government-supported funds or DFI-supported funds. So there is funding going towards adaptation, but it's just not going to startups that are driving solutions and innovations, especially at the earliest stage. So there's this kind of missing middle whereby you've got startups that are creating new solutions for people, for society, for us in the adaptation space, right? And they're too commercial for your philanthropic, concessionary, real kind of pure impact related sort of investors. And so therefore they might miss out on some of these large grants that are going towards infrastructure projects or renewable projects, and they don't get that capital. But they're too complex or too asset heavy for VC, right? There's the challenge that some and a lot of the early stage climate tech founders face when they're building an adaptation and/or adaptation/mitigation.
Are you decisively trying to push more capital towards adaptation and trying to avoid mitigation, or what's the percent breakdown in your portfolio?
We are intentionally expanding our sourcing and, of course, doubling down on some of these ecosystem development activities that drive more adaptation deal flow, that drive different types of dynamic capital that can go into adaptation. But are we decisively avoiding investment mitigation? No. And look, right now, I would say we've got several mitigation-only startups, and we've got several that are both kind of mitigation and adaptation that cover both sectors such as food, sectors such as agriculture, even nature-based solutions as well sometimes can cross over. So that's how we construct the portfolio.
If you had to estimate what percent is mitigation versus adaptation of capital deployed?
From our fund, I would say roughly kind of 60-40.
So you're not following the 90-10 lopsidedness, you're pushing the other direction. Yeah. So let me ask you, since we established that you're commercial first, but definitely trying to have impact at scale, how do you actually measure impact and intentionality and additionality during due diligence? And a lot of climate funds get accused of greenwashing because they're just backing companies that are good businesses with incidental environmental benefits. But we all know in these conversations, measuring impact is pretty hard. It's messy. It's often gets into subjective areas. How do you verify that a founder is truly building for climate outcomes and not just accidentally efficient? And are there KPIs or signals that tell you that this is real versus lip service and performance?
We really spend a lot of time thinking about exactly that. How do we put the right checks and balances and the right systems and processes across the board, right? So it's not just at sourcing or not just at DD, but across the entire sort of investment process to ensure that we're actually investing in the right companies that really believe and have that intention to have direct or indirect climate impact. And actually, one of the things that really fascinated me, and this is where perhaps we're slightly unconventional in nature, is that because we play in such an early stage of, pre-seed and seed, we see a lot of founders that are building incredible companies where they haven't thought about their climate impact. A lot of what we do is to identify that and help them build a robust enough system by which they can measure, monitor, and leverage their climate impact. Looking at, for example, their life cycle analysis and looking at the entire sort of value chain of a company and actually really thinking through where climate can or is impacted from different lenses is part of our mandate. I even remember saying to a lot of founders, like, you might not think that you're a climate startup. You might not look like a climate startup, right? Because we're so used to having climate startup is in clean tech or renewable energy, right? But actually, you could be a logistics fleet management company and have an incredible climate impact, right? That's an important point to mention. How do we measure it? The other thing is, like, we didn't want to create a new proprietary system just to sort of show that we're creating something new. There's a lot of great climate management and impact management systems and processes and templates. There's now communities that are built around supporting each other and sharing that information. But what we did do is say, well, where does it matter for us? And as I mentioned previously, for us, it's different 3 levels: venture level, portfolio level, fund level. It is very much across embedding, and we call it the performance management framework, that encompasses both commercial growth metrics, climate mitigation metrics, and climate adaptation metrics. So we're measuring your IRR and your MOIC as a fund, as well as your unit economics, whilst also measuring GHG emissions avoided or households improved and hectares of land under sort of climate resilient practices. And it wasn't as easy as it sounds, but we've integrated the two and we very much see the two kind of interplaying. In terms of specifics, we've leveraged, again, not our work. We bought this because we think it's a really great framework, which is called the 6-dimension analysis. It really goes through kind of 6 elements of who is being impacted, how they're being impacted, how is it being delivered, looks at risks, it looks at contribution to broader systems change. Is it being done equitably? Is it done sustainably? So we use that as part of our due diligence. And then we use that as part of diagnostics to then work hand in hand with each founder to build their specific climate management plan, let's say, so that they can then manage it and measure it themselves. So a lot of it is about also, again, co-building something that's individualized and tailored, and also equipping the founders so that they can do it themselves going forward, because we won't be there for the journey of their business.
Is it all climate oriented, or do you have also social impact?
So we look at ESG as well. That's very much focused on identifying potential risks and then how do we mitigate or potentially mitigate some of those risks. And we look at inclusivity and diversity, very much leaning on the framework of the 2X community, is bringing in the DEI lens and looking at that both from a gender, but also it's not just about gender, it's about other type of diversity as well.
Can you walk me through your investment strategy and your systemic drivers that you're focused on? I think the Radical Fund is focusing on 5 sectors. It's agriculture and land use and energy and the built environment, industrial processes, transportation, and water and waste. Is that right? And how did you land on these?
The investment thesis itself has not evolved, but how we approach it and how we source companies and where we invest has actually evolved. We first mapped out, we've actually written a report around it. We've done an enormous amount of research around what the different, let's call it, subsectors are within mitigation and adaptation and where they overlap. And when we first started, I remember in the first year as a team, we're coming together and we're saying, actually, there's a lot of sectors that this involves. And so we went through an exercise of really focusing on where the priority areas are that are specifically applicable, appropriate, and obviously important to, again, Southeast Asia, where we have an outsized potential to deliver exits and returns, as well as have an outsized or scale of impact. So that interplay between the two has always been there and top of mind. Where we are now, those kind of sectors are correct, but the way we're actually structured is we now work very closely with the studio, and together collectively we identify what we call pods, problem-oriented deep dives. And in each sort of given moment over, let's call it a 6-monthly cycle, although that cycle kind of continues and can compound, we unpack these opportunity spaces within each sector. So rather than looking at energy and saying, we invest in energy, we actually dive deeper and identify those complexities, real sort of sticky opportunities across our markets, right? Where we can build and invest in. So in this instance, for example, of course, within energy, we're looking at decarbonization. We're looking at energy efficiency and energy optimization. We're looking at data centers and optimizing for energy use within data centers. In agriculture, that would be around, again, food systems and value chain across agriculture. So we've turned around how we look at these sectors and work really closely with the studio to deliver on that.
We're going to get to the studio shortly, but you touched on it a few minutes ago about these companies that don't really know that they're climate companies. And I think actually you articulate something that you call investing in non-obvious climate companies. So it's kind of a investment thesis for you. Can you just take me through the logic?
We're doubling down, and this is with the onset of the technology, and certainly AI has a big role to play in it as well. We're looking for people who've spent time in the industry, in a specific sector, where they really understand the pain points and the gaps of that specific industry, and they are in close proximity to those problems. They may have started a venture in that space because of the obsession with that problem and wanting to actually fix that problem for themselves. And so those are the type of entrepreneurs that may start, again, companies where they see an opportunity. They might not even think about it as, oh, I'm starting a climate company. They're starting a company that addresses a problem that it has a potential customer. So that's who we look for, both companies that we're building, but also companies that we're investing in. And I think that, again, it's a different way of sourcing founders that we think will have what it takes to build incredible companies that are impacting not just a region, but also global scale and global growth, and therefore global impact as well.
Can you make this concrete with one or two examples of real portfolio examples, 2 or 3 companies from the Radical Fund that demonstrate your thesis in action?
We've invested in a company called Dash. Dash, 2 co-founders, Aditya and Robert. They are based in Indonesia, and they both come from very sort of product-focused backgrounds that previously worked in Grab and Gojek, so they understood the space of logistics very well. And they started a white label EV, so electric vehicle-based fleet management business. And they're serving small, medium enterprises, basically enabling them to create their own fleets, but utilizing and providing both drivers and electrical vehicles. So they have obviously an incredible impact on reducing emissions as opposed to utilizing your normal motorcycles. We really loved the founders for many reasons. They have really exuded and showed how much knowledge they have in their space, and they have showed how much they have learned from their previous employers, if you like, and understood the dynamics of Indonesia. That's also important, is knowing your market and therefore knowing your consumer base. And they've been growing incredibly well. It's been just over a year since our investment. Indonesia is a big market. We'll stay in Indonesia, but who knows, maybe they'll scale beyond that country. So that's one example. Another example is a company called Alicia Bots. It's a Singaporean second-time founder. His name is Inder, who has developed a robot-based crawler. So it looks like a robot that basically cleans the hulls of ships. And you might ask yourself, what is the connection? Well, actually, the process is incredibly manual. If you think about the maritime industry, in that you have actual human divers going every time the ship is stationed and cleaning all of the barnacles, all of the slime that's built up over the passage of the ship, that actually contributes, because it slows down the vehicle, it actually contributes and can contribute up to 20 to 25% of GHG emissions because of the extra energy use. So he's developed this robot that not only cleans, it also provides prevention and inspection basis for capturing data around any potential risks of the ship. So it's all around preventing that buildup and therefore preventing the expenditure of energy. A really interesting business. As I mentioned, they started in Singapore. They've actually since have expanded to Greece and received global funding from both a global and a European VC. And he's looking to expand across Europe and hopefully the US as well. 2 very different companies that, again, on the surface, you might think it's a maritime robotics company or it's a fleet management company, but actually there's a lot of climate impact embedded in their business models.
I want to move on to some of the other things that you're doing with Utopia. And I think you position Utopia as a venture builder model, which is what distinguishes your approach from a traditional VC. And this is something different. With the studio, you're pivoting to an AI native model using something called Utopia OS. Give me an overview of the studio and Utopia OS, and what is it? What does this AI native ventures studio actually do? And what human functions are you replacing with AI versus augmenting human functions?
Utopia is a platform of both investment vehicles as well as venture studio. So we're sitting at the strategic advantage of having both the capital as well as the technical expertise and the tech infrastructure. The studio is, first of all, really proudly that it is the Qatar's first AI native studio. And so it's actually the first venture studio in Qatar that is servicing the global south. So the studio is actually building and working with entrepreneurs and ventures across emerging venture markets, including working very closely with Radical and in the Middle East, looking at entrepreneurs in Africa and with time, Latin America as well. So it is the venture studio for the global south. What it does and why did it come about? This is our thesis. Our thesis is that with the onset of AI, it has naturally disrupted our business. It's disrupting venture capital and it is disrupting the way ventures are being built, the cycles of funding, the needs of infrastructure and what it takes to actually build a company, both in terms of the speed at which they're building, but also in terms of how they're building it. Before, to go from pre-seed to Series A, you might take 5 years in an emerging market and you need to raise multiple bridge rounds and actual rounds. Now you can have a solo founder that goes from idea to Series A in less than 2 years' time. And you can do it without having a co-founder, technical co-founder, and you might not need to raise that much funding. So there's this commoditization by AI where it's compressing both the venture development cycle as well as the venture capital cycles. And we're sitting at the epicenter of that. We're using it an opportunity to build with domain experts within these opportunity clusters, as we call them, or kind of these pods, where we are witnessing spaces that are untouched or high compounding opportunity spaces that are niche, that are not visible to the market. And we're building companies in those spaces that the funds can invest in.
What's actually happening in those 24 months? What specific execution risks, let's say in emerging markets, is this high-touch model addressing that a traditional VC can't solve?
And it all starts, as you're building a business, right? It all starts with defining, for example, the problem and building the first, let's call it MVP or prototype, the first version of your product. Traditionally, it could take weeks, right? To build a prototype or even to put up a website. You can do that overnight now using AI tools and different sort of tech stack to do that. So, the speed at which you're defining your problem and identifying that there's a space in which it's a valued space to build in. The second issue, or rather challenge for all founders, is how do you reach my customer? And first of all, who is my customer? And how do I test and validate with my customer? Again, traditionally, that could take weeks, even months, because there's no sort of silver bullet as to how you do that. With AI tools, you can do that in days. And then you go into actually turning these potential customers into early traction and converting these customers and then keeping them and engaging them and building attention, building adoption around your product. What used to take weeks and months can actually be compressed into a shorter time frame. Founders now, they might not need to hire a product manager. They might not need to hire an HR person. The nature of the type of people that you need also has changed. Operations completely disrupted the way startups are building. Therefore, the funds should and ought to look at these startups. So that's kind of the compression of the venture building cycle. And what we know is that in our markets, that is an opportunity, but you also need capital, dynamic capital, smart capital, aligned capital. That's where our funds come in. So both the Middle East Fund, Atypical Ventures, and the Radical Fund Southeast Asia, they invest in companies that the studio is building.
Is that how it starts first with the studio? builds it and you make investments along the way?
That's one way. Another way is that because the team is on the ground, they continue to source businesses like a traditional sort of investor would, right? If we're finding a business at seed stage and we see an opportunity to actually re-engineer and add the tech infrastructure, add the operational expansion support, we can do that through the studio as well. So it's either you coming in as an entrepreneur and the funds then invest, or you're coming in as a venture and the studio supports you to get to scale across the board. And overall, that means that we're building from idea to Series A an integrated journey for entrepreneur, integrating both technical support and infrastructure and integrated in the capital that we're investing in alongside.
How many ventures have you launched through the studio?
So the studio was just launched in November. We have 6 entrepreneurs that we're working with at the moment, and we're looking to spin them out by Q2 timeframe.
This is quite fresh. It's a very interesting concept, but as so much in AI, I guess the proof will be in the pudding. It all sounds like good ideas.
Absolutely. One of the challenges with climate in Southeast Asia, since we spoke so much about it, is we have seen so much opportunity in adaptation, for example, in early warning systems or disaster reduction, a topic that's close to my heart because I spent so much time in it. We have not seen any businesses around that. So the studio can actually build a company that the Radical Fund can invest in. So it's a huge opportunity for us to increase deal flow and build to the needs of the market in the region.
Earlier this year, around February, you launched Atypical Ventures in Qatar, and that's backed by the Qatar Investment Authority. And this is Qatar's first international early stage VC fund. You're operating under a QFC licensed entity and you're building a team of, 15 to 18 people in Doha. Walk me through the genesis of Atypical and how did the partnership with QIA come together? And what's the investment mandate in the sectors you're targeting in the Middle East?
So again, Atypical is under the Utopia platform. So it's our Middle East fund. All of our funds are operating under that same framework of pods and looking for domain experts. In terms of sectoral focus, that's what it is, but it is sectorally broad. Again, looking at sovereign intelligence, for example, as one of our pods, looking at again, energy infrastructure is another pod, which, by the way, is so exciting because we can now have strategic arbitrage around knowing how to build businesses across Middle East and Southeast Asia and actually create that corridor from the get-go. And so we have portfolio companies that are coming from Southeast Asia to Middle East and Middle East going to Southeast Asia. And that's very unique. But Atypical Ventures was officially launched and first close was held early this year. It is a regional fund. Doha and Qatar is our home. So it's our HQ as Utopia, as the asset manager. And we invest across Middle East, which includes GCC, Levant, but also Pakistan and Turkey as well. So that's the geographic scope.
So make the case for me. What makes Qatar uniquely positioned to connect the Southeast Asia, Africa, and Latin America in ways that Silicon Valley or London can't?
I was at a really interesting gala the other week where Sheikh Al Mayasa, who's an incredible and influential person in Qatar and the world, has said the following. She said, "Are we the Middle East, the Middle West, or the center of the world?" And we are the center of the world here, both in terms of physicality between Africa, Europe, and Asia, but also in terms of the availability and the intentionality from the sovereign or from the government perspective, from the private sector perspective, in bringing talent here and establishing a hub here that actually serves emerging markets. No other region, no other country has had that mandate or that intentionality to do that. It's very unique and it's part of Qatar's Vision 2030. How do you diversify across the different sectors? How do you build this knowledge economy? How do we build the innovation ecosystem? And how do we actually leverage and bring and do that for the global south? So for us, it's a natural home. We are the first international VC to get QIA's backing, which we're incredibly proud of. And we're making it into a kind of an innovation hub for the markets that we have been building and investing in and will continue to invest in. So it's an incredible country.
You've described this approach as focusing on pods, problem-oriented deep dives, and your idea is to transfer business models, intellectual property between regions. But I got to believe that cross-cultural translation's pretty difficult, and you Doesn't seem like you can just copy and paste a business model from Lagos to Doha. What have you learned about things that are universal about human behavior and entrepreneurship? And what are the things that are deeply local and can't be transferred?
I absolutely agree with you. You can't copy and paste. I hear a lot of this company was successful in the US. Why don't we just do something here that's exactly the same? I don't believe that works. I do believe, though, that there are more opportunities and synergies and similarities, for example, for a startup that may be scaling from one region in another region than the proximity of its countries nearby. For example, it might be like Alicia Bots has, easier and better and more valuable to scale from Singapore to Europe or from Singapore to Qatar or anywhere else in the GCC than it is to go to Indonesia. That is true. Why? Because a lot of the problems are the same. Not exactly the same, but there's a lot of similarities. So again, for example, looking at decarbonization industry, which is critical for the Radical Fund, looking at cross-border logistics, looking at materials, looking at energy consumption and optimization, looking at data centers and data cooling solutions, that is also applicable to and in the GCC, not least opportunities around food and agriculture and water tech. Look at the solutions around vertical farming, solutions around supply chain management for agri inputs and outputs. A lot of these are very much transferable. We have a company right now that there's an opportunity for them absolutely to come to GCC that's in B2B procurement in food supply chains. It's a big pain point in Qatar, and there's a lot of corporates and stakeholders here that would want to work with them. So again, a lot of similarities. Where it is different, regulatory environment is different, and need to absolutely be mindful of that. Sometimes it is more flexible, sometimes it is less. And that's where we spend a lot of time, is navigating that. Where it is different is also, again, cultural or demographic dynamics may be different, but you need to be mindful of. And the way, again, it comes back to that customer behavior. We've learned quite early on that you can't just build SaaS or asset-light companies in emerging markets. You have to have an element of offline and online component, because trust is such a big aspect of building a company here. And that is the case in Southeast Asia, that is the case in GCC, but it's a different dynamic of how you build that trust. Spending time here is very important, whereas in Southeast Asia, it's around proving results that gains you that trust. There's regulatory, there's obviously cultural sort of demographic dynamics around impacting customers. And then there's the pure sort of form of operationalizing a business, of course, is also something to be mindful of. But what cuts across is opportunity, technology that is kind of ubiquitous, and that is something that you can plug in and leverage.
I wanted to pick your brain on climate and consumption in the emerging markets. You've said that asking the poorest 50% of the population to sacrifice for climate is elitist. They're only responsible for 10% of the emissions, and they bear the brunt of the climate impacts. But the real explosion in emissions is Southeast Asia and the Middle East is coming from the emerging middle class, who finally have the money to buy air conditioners and need and drive cars. So how do you invest in companies that enable aspirational consumption without directly contributing to environmental destruction? Is the answer simply to make it cleaner, or do we need to fundamentally redesign what middle class life looks like in the global South?
Somebody once said that if there was no poverty in the world, there would be no climate crisis. And I really believe that. Consumption is inevitable. Again, speaking for Southeast Asia, it is, on average, its GDP growth is far higher than the global average. I think we're this year at about 4.4%, just Southeast Asia. And so to think here, we're going to get people to all of a sudden change their behavior is perhaps a little bit radical, excuse the pun. So I think it's less about, is it consumption, is it bad, and how do we stop it? But more, to your point, is more about how and what people consume. And so what I think is an exciting opportunity is investing in innovations, both from an IP-led or product-led perspective, meaning actual new piece of product or a new kind of IP-led service, and business model innovation, different ways of engaging consumers and distributing a product or a service that is more efficient, that is less carbon intensive, that provides an alternative to the current ways of consuming or accessing. The heart of it is also, again, accessibility and affordability. The poorest people in the world cannot access medical or healthcare, and they probably cannot afford it either. So how do we build businesses that allow for that in a less carbon intensive way than what the Western nations have been building? So it's a real opportunity. And at the same time, affecting and impacting the bottom line, because we can do that at a very cost effective manner.
When you're talking about the future of climate investing in Southeast Asia, and you talk to institutional LPs who could deploy the kind of capital that's actually needed, what's the real reason they're not doing this? Is it because they don't believe the returns are there? Or is it something more uncomfortable, like they don't believe the people building companies in the global south are as capable as the people building companies in Silicon Valley?
It's hard to generalize. So if I think about why don't more LPs invest in emerging markets is what I'm hearing. Again, variety of reasons. I think there are still, of course, investors that are in countries where they have never experienced an emerging market. They've never had the opportunity to visit, let alone live. And therefore, their decisions are perhaps driven by fear and misunderstanding, not knowing, right? Plenty of people who wish they did know, but do not have that access to knowledge, or people that are on the ground. Of course, this is where we come in. There are also plenty of people who think they know, but they don't. And that's a dangerous game, right? Just because you've been on a safari in Africa doesn't mean that you know the continent. And it depends on the type of the investor. Again, if you look at family offices, if you look at high net worth individuals, if you look at impact investors, I think a lot of them are actually investing in emerging markets. And that has really changed. If you look at the more commercial investors, is there consideration around performance and exits? Absolutely. That is something that part and parcel of what, again, they're probably looking for over and above anything else. We play at the intersection of all those things. And so our investors that invest in us really care about driving innovation in a novel way and driving, of course, financial returns in a de-risked way, but also contributing to the ecosystem, right? And to building that startup ecosystem that we're doing at the same time. I think the world is changing. I think our LPs, types of investors are changing. But I think, again, as always, there's room to grow and there's room to change more.
As you look at the next decade, with the Middle East pivoting from oil to tech and Southeast Asia facing really existential climate threats, where do we need investors to be more unreasonable? And I say that because you are a mentor at something called the Unreasonable Group. What is the impossible thing you're betting on today that everyone else thinks is crazy?
Our sort of contrarian view, as you might call it, or the atypical view, which is the name of our Middle East fund, it's really around this different way of betting on a different type of an entrepreneur. And it's putting kind of VC on its head in a way and saying, actually, if we look at 10 years down the line, three things that we're considering. What is technology going to do to the industry, and how do we adapt now? And actually, more than adapt, how do we build into a new type of a model that will be here to stay? Because we think VC is actually going to look very different to what it looks now. We're, ahead of the game in terms of that. How do we bet on the different type of an entrepreneur with a different type of a team building different type of startups where people were building 10, 5, even 2 years ago? So betting on a different type of a founder and investing in places that are not obvious places, that are complex, that are compounding in nature over time, that are unseen, that are driven and underpinned by inefficiencies where traditionally kind of VCs would not go into. And it is about building a platform that we think actually serves those three opportunities, as opposed to what a traditional VC fund would look like.
Alina, I've got some short, rapid fire questions for you before we wrap up here. Don't overthink these and just give me whatever comes to your mind, or if nothing does, feel free to take a pass, because that's okay too. If you had to name the single most important challenge in the emerging market climate VC space at this time, what would that be?
Lack of dynamic capital, the availability of venture, debt, R&D, subsidies, and other types of funding.
What do you know now about climate venture building and impact investing that you wish you knew in 2018 when you co-founded Founders Factory Africa?
The need for constant iteration when it concerns impact management specifically, if that's what we're talking about. So I thought impact management was a process that you apply, but it is, like all things in innovation and entrepreneurship, continuously changing, and you really need to iterate like you do in other parts of the business.
This is an investors podcast, so you don't have to name names, but can you describe an investment that you made that you were convinced of at the time? It ticked all of your impact boxes, but in the end, it didn't turn out. And what were the lessons learned from that experience?
I can give an example actually of one that we didn't end up investing in. And it's an interesting one because it was a circularity startup selling electrical goods as well as excess fashion on a marketplace, and therefore wanting to have an extended product life and reduce emissions. But what we realized is actually for it to scale, which is what we want in order to have both commercial and impact at scale, is that it would need to expand and become a more traditional e-commerce play. And by doing that, it would need to expand to other product lines that would evolve away from a circularity nature of the company and would need to compete with other e-commerce players. That was not the only reason why we didn't invest in that company, but it was a really robust and interesting conversation when we had at the time about how impact changes as, an early stage business continues to grow.
And in the end, did it go pear-shaped?
I think they're still around, but it's only been a couple of years. We hope it does scale, but it might look very different to when it started.
Let me ask you the converse of that. If you could describe for me an investment that you had some level of skepticism about it when you were investing, or perhaps you passed on it because you didn't believe in it. And in the end, the whole thing turned out way better than you could have imagined, and you were pleased you invested, or if you had passed on it, you wish you hadn't. And what was the investing lesson learned from that experience?
It was actually during COVID. At the early stage of investing, you really need to spend time with the entrepreneur because they're really behind building this venture and they need to pivot when the time is right. So you really need to spend time with the entrepreneur. And during COVID, of course, we couldn't, right? This was a founder that actually I was skeptical about because there's nothing like spending time in person and really understanding the intention and the goals and motivations behind building a company. And they've turned out to be one of the best entrepreneurs. Again, goes to show, spend as much time with the founder and in person if possible.
Because of COVID, weren't able to put that much face time in, and you passed?
No, we did invest, but I remember being skeptical about that founder and the company, which turned out to be a really excellent venture.
And the last one is, if someone wants to get into the climate VC and venture building space, but in the emerging markets, where or how would you advise them to cut their teeth and start out?
I would say move to an emerging market. Simple as that. You cannot start until you live and breathe, understand, and really embed yourself across all aspects of society, of business, experience it, because you can't build a business from London in Indonesia. You can't build a business from New York in Qatar, right? You have to build in the market and you have to really understand it. I always encourage people to move to any emerging market because it's fascinating and the people are incredible.
You can't short circuit experience. You can't read about it.
No report, no research, no paper, no data points will give you the nuanced understanding of what you need to know to either build a company or be an investor in that geography. Being on the ground, having your team on the ground is absolutely paramount. So unless you're a private equity growth stage hedge fund who only looks at numbers and transactions, you cannot do that. You can't invest in emerging markets without being there.
Alina, this has been really fascinating for me. Your journey from Riga to Australia to building this platform across Southeast Asia and Middle East, Africa. It's extraordinary. You got a lot of great stories.
Thank you so much, Scott. I really appreciate the opportunity to share.
Thanks for taking the time to do a deep dive with me today. I learned a lot from it. Before we wrap up here, tell everyone where they can find out about all the great things that you're doing at the Utopia, the Radical Fund and Atypical Ventures, and how can they connect with the work you guys are doing?
So we're publishing all of the pods, the problem-oriented deep dives. We're publishing all of our work online because we need to share our insights, our research, our data points, and all of that we're working on so that we can attract the right partners, the right founders. I suggest you go to theradicalfund.com to learn more about Radical and utopia-studio.co to learn more about the studio. That's where you'll find more of our work. For Atypical, it is atypicalventures.com as a website as well. You'll find more of our work there. And connect with me on LinkedIn.
Everyone should definitely check out utopia-studio.co. That's for the platform, and the radicalfund.com, just like it sounds. And that's for the Southeast Asia climate work. And a-typicalventures.com for the Middle East Ventures Studio. Is that right?
Exactly right.
And follow Alina on LinkedIn. Reach out to her there. So, Alina, thank you so much for this.
Thank you, Scott. My pleasure.
Thanks again. Goodbye, everybody.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.